You've probably heard that investing in real estate is one of the safest ways to build wealth. But what if I told you that Warren Buffett, one of the most successful investors of all time, avoids the real estate market? Yes, the man who turned small sums into a fortune of over $100 billion prefers to stay away from this type of investment. Why? In this video, we're going to explore the reasons behind Buffett's decision to avoid the real estate market and how this choice aligns with his investment philosophy. I'll show you the key arguments Buffett uses to justify his position and how these ideas might change your perspective on where to invest your money. If you're curious to understand why one of the greatest investors in history doesn't put his money into real estate, stay with me until the end. You might be surprised by the lessons you'll learn. Topic 1. Warren Buffett's investment philosophy. Before we dive into the specific reasons why Warren Buffett avoids the real estate market, it's important to understand his investment philosophy. Buffett is famous for his disciplined and long-term approach, focused on investing in solid companies with enduring competitive advantages, also known as moats. Buffett follows the teachings of Benjamin Graham, his mentor, and the author of The Intelligent Investor. He firmly believes in investing in businesses that he can understand and evaluate clearly. For Buffett, a good investment is one that he can hold forever without worrying about market fluctuations or the daily management of the asset. This is where his aversion to the real estate market starts to make sense. Buffett prefers to invest in companies with strong management, a powerful brand, and a proven ability to generate long-term profits. He likes businesses that can be automated and that don't require much intervention. Real estate, on the other hand, requires constant management, maintenance, and is subject to market variations and operational issues that are beyond the investor's control. This need for active management is one of the main reasons why Buffett prefers to stay away from the real estate sector. Disadvantage 2. Real estate lacks flexibility. One of the key points Buffett highlights when discussing the real estate market is the lack of flexibility in this type of investment. Real estate assets are physical, immovable by nature, which means they cannot be easily liquidated or transferred from one market to another. If the real estate market in a region declines, the investor is stuck with that asset, with few options to react quickly. Buffett, on the other hand, values liquidity in his investments. By investing in publicly traded companies, he can sell his stakes at any time, reallocating his capital to where he sees the best opportunities. This flexibility is essential for Buffett, who likes to have the ability to move his capital according to market conditions and emerging opportunities. Moreover, the illiquidity of real estate means that in times of crisis, it is much harder to exit a real estate investment without losing money. Selling a property can take months or even years, depending on market conditions. For Buffett, this lack of flexibility is a significant disadvantage, especially when compared to the ease with which he can buy and sell stocks. Disadvantage 3. Lower returns compared to other investments. Another reason why Warren Buffett avoids the real estate market is the relatively lower returns compared to other types of investments. While real estate can offer stable income through rents, the total return on investment often doesn't compare to the potential gains from stocks, especially when considering capital appreciation over time. Buffett prefers to invest in companies that have the ability to reinvest their profits into operations that generate more growth and, consequently, increase the value of the shares. These companies have the potential to offer significant compounded returns over the years, something that real estate, with its limited appreciation and capital-intensive nature, rarely matches. Moreover, the real estate market can be highly cyclical, with periods of high appreciation followed by sharp declines. This kind of volatility, combined with ongoing maintenance costs and the risks of vacancy when the property is without tenants, makes real estate less attractive to Buffett, who prefers the stability and predictable growth of well-managed companies. Buffett also points out that unlike companies that can grow exponentially, the real estate market has a natural growth limit. A company can expand its operations globally, develop new products, and significantly increase its customer base, while a property is a fixed asset that, at best, can be rented or sold for a higher price but rarely offers the same growth potential. Disadvantage 4. The burden of active property management. Buffett is known for avoiding investments that require active and intense management. Real estate, especially rental properties, requires constant administration, from tenant selection to regular maintenance, and dealing with problems that arise over time. Even when a property is managed by a third-party company, the owner still needs to be involved in strategic decisions and monitor the asset's performance. For Buffett, this is the type of work he prefers to avoid. He believes that his time is better spent analyzing and selecting stocks that don't require this kind of constant involvement. Investing in shares of large companies allows Buffett to focus on high-level strategic decisions, leaving daily management to the executives of those companies, whom he trusts. Additionally, active property management can be stressful and unpredictable. Issues such as delinquent tenants, unexpected repairs, or regulatory changes can negatively impact the profitability of a real estate investment. For someone like Buffett, who values simplicity and predictability in his investments, these factors make real estate less attractive. In contrast, by investing in shares of stable and well-established companies, Buffett can rely on a professional management team to handle operational details while he focuses on evaluating the company's overall performance and making capital allocation decisions. This approach allows him to maximize his efficiency and minimize the risks associated with active management. Now, have you ever thought about earning between $5,000 and $10,000 per month as extra income by creating simple videos for YouTube like this one? I have a complete and straightforward course that I developed for a single payment of $29.90. $29.90 won't make you richer or poorer, but what if this program works for you? Well, the link is in the first pinned comment of the video and in the About section of the channel, okay? If you're interested, just click the link to know more. But now, back to the content. Disadvantage 5. High transaction costs and taxation. Buffett also points to the high transaction costs and tax burden associated with the real estate market as reasons to avoid this type of investment. Buying and selling real estate involves a series of expenses, including brokerage commissions, registration fees, appraisal costs, and property taxes. These costs can significantly erode profits, especially in short-term transactions. Additionally, the real estate market is subject to specific taxation that can be less favorable compared to other investments. Property taxes are recurring and can increase over time, depending on the region and local legislation. Even if the property is appreciating, these taxes remain a regular expense that reduces the investment's profitability. On the other hand, investments in stocks have relatively low transaction costs, especially with modern brokerage platforms that offer reduced or even free trading commissions. The taxation on capital gains from stocks can also be more favorable, depending on the holding period and the jurisdictions involved. Buffett prefers investment strategies where entry and exit costs are minimal, and where taxation can be optimized, allowing him to maximize his return on investment. The real estate market, with its high transaction costs and constant tax burden, doesn't offer the same cost efficiency that he finds in investing in stocks. Disadvantage 6. The localized nature of real estate. Another reason why Buffett avoids the real estate market is the localized nature of this type of investment. Real estate assets are physical and tied to a specific location, which means that the performance of a real estate investment is heavily dependent on the economic, political, and social conditions of that region. Buffett prefers to invest in companies that operate globally or in broad markets, where risk is diversified across different regions and sectors. A company like Coca-Cola, for example, has a presence in almost every country in the world, which means its performance doesn't depend on a single local economy. This geographic diversification is something that real estate simply cannot offer. Additionally, the location of a property can be a significant risk factor. Changes in local policies, such as new zoning regulations, tax increases, or infrastructure changes, can negatively impact the value of a property. This risk is amplified by the inability to move the property to a more favorable location, something that global companies can do by adjusting their operations. For Buffett, the idea of being tied to an asset located in a single region without the flexibility to respond to market changes makes real estate investment less attractive. He prefers the mobility and adaptability he finds in investing in well-positioned companies on the global stage. Disadvantage 7. Focus on simplicity and clarity. Buffett is famous for his aversion to complexity. He prefers to invest in businesses that he can easily understand and that have a simple and straightforward operation. Real estate, although it may seem simple at first glance, can involve a series of complexities, from legal issues to maintenance and tenant management problems. Buffett prefers to avoid this kind of complexity. He seeks investments that offer clarity and predictability, where revenue streams and risks can be assessed accurately. Companies with clear business models, such as consumer product manufacturers or financial services firms, offer this simplicity that Buffett values. Moreover, simplicity allows Buffett to make quicker and more informed decisions. By investing in stocks of companies with easy-to-understand business models, he can focus on analyzing what really matters: the company's fundamentals, the quality of management, and the potential for long-term growth. Real estate, with its numerous variables and nuances, simply doesn't fit into this simplicity model that Buffett seeks. Disadvantage 8. Better opportunities in other markets. Finally, Buffett avoids the real estate market because he sees better opportunities in other markets. He believes that by focusing on investments he understands deeply, and where he sees significant growth potential, he can achieve superior returns. For Buffett, the real estate market simply doesn't offer the same level of opportunity that he finds in the stock market. Buffett has an exceptional ability to identify undervalued companies with growth potential. He prefers to invest in companies where he can apply his knowledge and experience to generate value. The real estate market, with its focus on physical assets and reliance on external factors, doesn't offer the same opportunity to influence or optimize the investment. Additionally, Buffett sees the stock market as a place where he can find a wide range of opportunities, from emerging tech companies to established giants with stable revenue streams. This diversity of opportunities is something that the real estate market, with its focus on local and specific assets, cannot offer. Warren Buffett avoids the real estate market for a number of well-founded reasons: lack of flexibility, lower returns, the burden of active management, high costs, the localized nature of real estate, the complexity involved, and the belief that there are better opportunities in other markets. He prefers to invest in companies where he sees growth potential, operational simplicity, and the ability to move his capital easily. If you want to follow Buffett's example, it might be time to reevaluate where you're investing your money. Does the real estate market really offer the best return for your capital? Or are there better opportunities waiting for you elsewhere? Leave your comment below and share your opinion. If you liked this video, don't forget to hit the like button, subscribe to the channel, and for more tips on smart investing, watch the next video that's appearing on your screen now. See you next time. I'll see you there.